don't need a PhD or an expensive advisor to be able to create a portfolio that will outrun cash in the long run. Today, I'll show you 7 different real portfolio strategies, each with their own ETF picks, exact percentage breakdowns, and which one may be best fitted for you based on your risk preference. I picked ETFs based on their low risk management fees and high growth potential. But these are portfolios that pretty much any beginning investor can assemble. However, I will rely on you to do some additional digging into each ETF and see if it suits your preferences. So number 1, total world equity or all equity simple. The allocation, 100% global equities. ETF examples, VT, Vanguard Total World Stock ETF, or ACWI/XIU/VEQT, Canadian alternatives. So why use it? Single fund simplicity. Own the global stock market with simply one ticker. Highest long-term expected return among easy options because it's 100% equities. Great if you have a long time horizon and high risk tolerance. The risks? Expect more drawdowns in bear markets. This strategy is a more buy and hold for the long term. Number 2, the 80-20 growth, equity heavy. The 80% could be made up of 60% US market in such ETFs as VTI or VOO, and the remaining 20% could be composed of international equities such as VXUS or IXUS. Now that we have the 80% of the equities taken care of, the remaining 20% we could put into bonds, such as BND or VAB. So why use this? It's a strong, straightforward push towards higher returns, but also minimizes volatility through bond investments as well. It's very easy and simple to just implement 3 ETFs.
Risk note. Higher long-term return potential than 60/40, but larger short-term drawdowns, not for investors who can't tolerate volatility.
Performance context. On average, the 80-20 mix has returned higher annualized returns for investors than a normal conservative mix. Number 3, the 3-fund portfolio. Classic Bogleheads.
Allocation, exact. 60% US total stock, VTI. 30% international stock, VXUS. 10% total bonds, BND. ETF examples, VTI plus VXUS plus BND, or Canadian equivalents, VUN, XEF, VAB, or a single Canadian, all-in-one like VCN plus XEU combos.
So why use it? It's simple and increases your diversification across domestic, international, and bond markets. It's also customizable. You can adjust the ratio of stocks to bonds based on your risk tolerance, and it's easy to rebalance every year. So the risk notes is mid to high equity exposure because it's made up of 60% stocks. So it's a good blend of risk versus return for most savers. Number 4, the golden butterfly, balanced growth plus defense. The allocation, 20% large cap US stocks, 20% small cap value US, 20% long-term bonds, 20% short-term bonds, 20% gold. ETF examples, VTI or S&P VOO for large cap, IWN/IWS/IWN like small cap value. TLT, long treasury, plus SHY or VGSH for short term. Physical gold ETF, GLD or IAU or country available GLDM. So why use it? It's built to capture the equity upside while limiting drawdowns. It's good for investors who want a safer, equity-heavy alternative with explicit inflation/deflation diversifiers. The risks and maintenance, it does have moderate volatility, does provide very well-adjusted returns, provided you keep the portfolio in balance. However, it does have to be rebalanced every year because of that 5-way split. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. Consider subscribing to my channel or else I'm going to have to run you over with my Zamboni. No, seriously, I do make very informative and educational videos with a touch of entertainment. If this sounds like something you'd be interested in, I'd love to have you as a subscriber. Number 5, the Ray Dalio All-Weather portfolio. I couldn't talk about portfolios and not mention this famous portfolio.
The exact allocation, easy version is 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. ETF examples: VTI, VOO for stocks, TLT, VGLT for long bonds, IEF, VGIT for intermediate bonds, GLD, IAU, GLDM for gold, commodities ETF, PDBC, or diversified commodity exposure.
Are you still with me here after all of these acronyms? So why use this portfolio? Because this is said to weather the all-weather, deflationary, inflationary, recessions, booms, everything you could possibly imagine. It's designed to build smooth, steady returns over time. The risks? Well, this type of portfolio obviously has lower than expected volatility. However, you won't see amazing returns from this portfolio, but it's more for conservative investors who want steady, reliable growth over the long term. Number 6, the permanent portfolio, Harry Brown. The allocation, 25% stocks, 25% long-term bonds, 25% cash, T-bills/short-term bonds, 25% gold. ETF examples: VTI/VOO for stocks, TLT/VGLT for long-term bonds, SHV/SHY or ultra short-term treasury ETF for cash, GLD/IAU for gold. The risks? Lower volatility and good capital preservation. Historically, this outperforms cash but lags behind other equity portfolios. Again, this is a portfolio designed for long-term investors who favor stability over growth. In, say, a bull market, you won't be jumping up and down with joy, but you will enjoy a little bit of appreciation. Number 7, the growth tilt. Cash plus NASDAQ over tech tilt. The allocation? 50% broad US, S&P/total market, 30% NASDAQ/tech growth ETF, 10% international, 10% bonds or cash. ETF examples: 50% VOO or VTI, 30% QQQ, NASDAQ-100 or a growth/mega cap ETF, 10% VXUS, 10% BND or SHV. So why choose this portfolio? Well, this one gives you a broad core exposure over many of the tech companies and industries that usually produce higher growth returns. It's also easy to implement and rebalances annually back to its original tilt. The risks? Well, you get much better returns, but there's also a lot more volatility. It's great if you want large growth and returns. However, you have to be prepared for those large swings in valuations. An example is QQQ, which has typically outperformed the S&P over many years. However, when there's downturns, it usually has dropped more than the S&P 500.
So, which portfolio should you pick? Use these as general guidelines and indicators, but again, please do your own research. If you want the simplest pick, Total World, 100% VT. If you want more upside and can handle volatility, 80/20 or growth tilt. If you want balance with a defensive mindset, Golden Butterfly or permanent portfolio. If you want smoother performance across macro regimes, all-weather. If you're new, pick one. Open a low-fee broker account, or your TFSA, RRSP if Canadian, buy the ETFs. Set an annual rebalancing rule, for example, once a year, plus or minus 5% bands, and stick to it.
Just pick one of these portfolios and start off small. See how you do. If you feel comfortable with it, what your risk tolerance is, if you enjoy actually rebalancing it, or if you want a more hands-off approach and invest for the long term. If you're comfortable with swings and volatility, or you don't want to worry and prefer stability. There's no one perfect portfolio for everyone, as everyone's unique. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst. living in Western Canada. I talk about personal finance, investing, and investment portfolios. If this sounds like something you'd be interested in, consider subscribing to my channel. So in the end, simply pick one and keep investing into it. Small, consistent steps beats perfectly timing the market. If you're interested in 2 more great videos about investing, check out these 2 videos here.